Cycles here with the weekend update on May the 11th. So I'm looking for the 10-week oscillation high. That will be my main focus in this video. See, I have up here, I have put the length between the 10-week oscillation tops. And currently, we are 12 weeks from the previous top, and we should soon, well, we should now around this time, we should turn down to make a 10-week oscillation low. But it's a bit more complicated than that. Currently, my 4-week cycle in green is now turning down to a 2-week oscillation low. And although the cycle does not look very bearish at this point, it certainly can be a bearish downswing. Like going back at this point, it was deep downswing, or this one was quite deep, or if you look at this one. So it definitely has a potential to make some kind of downswing here. The bias for this coming week is mostly bearish. But first, let's zoom out a little bit and look at the overall market, because we have a 28-year cycle in the inflation-adjusted S&P, and it's alternating between a war cycle and a financial crisis cycle. Now, you can have both war and financial crisis, but the dominating part usually is a war cycle every 56 years. And currently, at this point, I have marked the analogs here. And if we go back 28 years, we come to 1998. Well, that was not bearish at all. But if we look at the other ones, mostly we have a bearish setup. And I'm looking at an analog from the 1970s here in red, and we see this it's projecting a very bearish outlook for the next year or so. Also here we have the 56-year cycle in global deaths in conflicts going back several hundred years. And currently we are in such a war cycle top now in the next 7 years or so. Also, we have a very important cycle of 3.5 years here in red. And currently, we see the cycle is now very bearish. So if we go back from my memory here, what has been my market outlook here? I started my videos at this point, in just before the Ukraine war. And I had already for a while been looking for a market top, and then finally we broke the 200-day moving average at this point. And the first video in this channel was just before the Ukraine war started. At this point, I said the market should be bearish at least until this point. That was the fall of 2022, but I was expecting the market to continue to be bearish into 2023. So when market did not break the 3.5-year average here, I was still selling, or I was recommending to sell the rallies, but I said this does not look really bearish. And as the market continued not to break down, I was losing, I could not defend being bearish here, but I didn't want to get bullish either. That was a kind of a subjective personal opinion that this should have broken down deeper. Anyway, when we came to late spring 2023, I could not stay bearish anymore because the cycle was shooting up. So also, I said I was expecting a big ABC bull market because that's how they looked in the 1970s. And we got this deep B move here. And I said there's no reason to sell before we come to very late 2024. Although around late summer 2024, I said it is possible with an early top. And we were making some choppy sideways market looking like the market was starting to top out, but no, we rallied all the way into early 2025. So at this point, I said, personally, I do not trade the market, but I advise my employer about market positions, and we sold out in the middle of February. And we will stay in cash until around spring, summer next year. That's the easy way to handle this market. be long when the cycle is bullish and stay in cash when the cycle is bearish. Now, there's no guarantee here that the market will crash down, but there's a very high risk, in my opinion. We could get something like this. And then I would start to, or advise my employer to start entering long positions when we come to around this point. But no, we really don't know. It could turn out something like a more sideways market, and in that case, my employer would probably get into the market maybe around the same price or even a little bit higher than the price where we sold. But at least we have avoided this big risk here. So, there are many possible bear markets that could happen here. And we could, also even see some kind of a big double top and then crash down. So I really don't know, but that's why I'm making these videos, because let's see if we can um, find out how this market um, behaves in this bearish period. And today I want to focus on the 10-week oscillation. That is kind of a mystery to me. Is it a cycle or just a property of the market that it likes to oscillate with waves of around 10 weeks? Also, I noticed that, well, normally in bull markets, I measure this oscillation from low to low, but when the market turns bearish, you rather want to see it from top to top. So down here, I have a wavelet that corresponds to this oscillation, and you see from top to top, we have sometimes 12 weeks, sometimes just 8 weeks. On average, it's around 10 weeks, but here in the bear market of 2008, we see there's some variation to the length here. If we go to 2022, again, we see we have like 12 weeks, 8 weeks, 10 weeks, but when we get these long rallies, or I should say, this long period between tops of 14 weeks, then you have to start questioning, is the market now shifting into a bullish configuration? And indeed, that is what happened here in 2022. But if we get to 2001, it's a little bit more messy, because here you see in early 2001, we had a length of 14 weeks, just a little bit over 14 weeks, in fact. But that was a bull trap, and the market did turn bearish. And after the terrorist attack in 2001, it was really messy. We had something that looked like a 16-week rally. Well, in essence, I think this red thing here shows what, in essence, what really happened. So here it got very messy, but then we come back to a nice rhythm of 10 to 12-week oscillation tops. And let's have a look at where we are right now. At the moment, this works best when the market is topping and turning bearish. So here we had 8 weeks between tops, and then topping as a kind of a double top, 10 weeks apart. Now, currently, we are at about 12 weeks. So, if the market is bearish, we should top out right now. 12 weeks, normally, that's the length between tops in the bearish market. But then we have the tricky part. What if continues here with the red scenario with 14 weeks? Well, we could break a little bit above the 200-day moving average and make a nice bull trap here, and it could still be bearish. But when we are starting to stretch this into 14 weeks, we really have to question if this could be something more, if this is bullish. So I'm looking for this 10-week oscillation high. Ideally, it should be right now when we should go down to make low. And then I think we make a summer top, and this would be a range, and we will crash down in the fall. But if we make a bull trap here and go up for another 2 weeks, then we should crash down to lower lows. Unless this actually is bullish, and then we should consolidate and rally up to all-time high this summer. So, see you.